Today, signs of great economic management? ? Hello again, it's Martin North from Digital Finance Analytics, where I've noticed posts covering finance and property news with a distinctively Australian flavour. Well, the seasonally adjusted unemployment rate for April 2022 came in at 3.9%, according to the latest data from the ABS. That was a tick down, but not a big one. The ABS said, in April, we saw employment rise by 4,000 people and unemployment fall by 11,000 people. As a result, the unemployment rate decreased slightly in April, although remained level in rounded terms with a revised March rate of 3.9%. And 3.9% is the lowest the unemployment rate has been in the monthly survey. The last time the unemployment rate was lower than that was in August 1974, when the survey was quarterly. The unemployment rate for males fell by 0.2 percentage points to 4.0%. That's the lowest level since October 2008. For females, it remained at 3.7% for the second month, which is the lowest it's been since May 1974. The participation rate also decreased in April, down by 0.1 percentage points to 66.3%, but remained close to the historic highs in February and March. The employment to population ratio remained at 63.8% for a third month. That's the highest it's been, and 1.4 percentage points higher than in March 2020. Seasonally adjusted hours worked increased by 1.3% in April, largely reflecting a bounce back from the March falls in flood-affected areas. Hours in New South Wales and Queensland increased in April following the impacts of the floods in March. The number of people working fewer hours than usual due to bad weather dropped from its March peak of over 500,000 to around 70,000 people in April, the ABS said. In line with rising numbers of COVID-19 cases in April, though, the number of people working reduced hours due to illness continued to be high, reflecting ongoing disruption associated with the Omicron variant. Around 740,000 people worked reduced hours in April because of illness, almost double what we usually saw in April before the pandemic. Of those people, around 340,000 worked no hours, which was around triple what we would usually see. The underemployment rate fell 0.2 percentage points to 6.1%, and the underutilisation rate, which combines the unemployment and underemployment rates, dropped 0.3 percentage points to 10%. And those were at their lowest level since 2008. Across the states, the unemployment rate was lowest in WA at 2.9%, followed by the ACT at 3.1%, then New South Wales at 3.5%, Tasmania at 3.8%, the Northern Territories at 4.1%, Victoria at 4.2%, and then Queensland and South Australia at 4.5%, and the participation rate ranged from 60.2% in Tasmania up to 70.7% in the ACT and 73.7% in the Northern Territories. Now, 2 points to make here. Of course, we're still missing 500,000 or so overseas workers who went away and didn't come back. That's one of the reasons why the job numbers are where they are. The second is we are continuing to see in our surveys people who've decided to step out of the workforce simply because they cannot get work, they've moved towards retirement, or other reasons. So unfortunately, while this number sounds good at the surface level, when you drill down and start looking into more detail, it's really a bit of a blip. Now, of course, some will claim, see, policies are working. Others will say, no, this is more to do with statistical variation and the reasons I've outlined above, which means that the real true number is probably quite a lot higher. Now, it's interesting just picking up the latest Westpac leading index because there are some interesting trends to note. They said, recently, Westpac revised down its growth forecast for 2022 from 5.5% to 4.5%. That reflected the sharp increase in the cost of living as headline inflation lifted by 5.1% in the year to March 2022, including an increase of 2% in the March quarter and an earlier and more rapid policy tightening from the RBA. That said, near-term prospects are still positive, they say. Post-COVID reopening is expected to see a further solid lift in consumer spending as household savings normalise and more income flows through to spending. But In real terms, the extent of this lift will be constrained by the higher costs of goods and services. By holding comfortably below the zero level, the leading index is also consistent with above-trend growth in 2022 and a large boost coming in the June and September quarters. The index growth rate has lifted from minus 0.02% in November 2021, when the two major eastern states were just emerging from Delta lockdowns, to 0.88% in April 2022. The 0.91 percentage point improvement has been mainly driven by a lift in total hours worked, contributing 0.62 percentage points and accounting for about two-thirds of the turnaround. A widening yield spread, up 0.27 percentage points, and a lift in commodity prices in Aussie dollar terms, up 0.26 percentage points, with some additional support coming from dwelling approvals and US industrial production, adding 0.21 percentage points on a combined basis. Now, those improvements have been partially offset by a softening in consumer expectations. The Westpac MI CSI Expectations Index and the Westpac MI Unemployment Expectations Index taking 0.45 percentage points off the leading index growth rate on a combined basis. Of course, the Reserve Bank Board meets next on the 7th of June, and Westpac expects that the board will decide to raise the cash rate by a further 40 basis points to 0.75%. Most analysts favour a more cautious move of 25 basis points. Following an increase of 25 basis points in May, the move would unwind the emergency rate cut that the bank enacted during 2020, when the economy faced the COVID crisis. With the crisis having passed and the bank challenged with the daunting task of bringing underlying inflation down from a forecast 4.75% to 3.25% in 2023, that emergency stimulus is no longer appropriate. And they said the board will also be aware of the efforts of other central banks, including the US Federal Reserve, to quickly move interest rates settings back towards neutral. While current headline inflation in Australia is below these other countries, the RBA has started more slowly than central banks abroad, and inflation pressures are still increasing. So it is also much more prudent to front-load the increases where at a stage in the cycle when interest rates are clearly below what could be considered a neutral level. And finally, the mood among Australian consumers continues to worsen, with the ANZ Roy Morgan Consumer Confidence Index plunging to its lowest level since mid-August 2020, when Australia was in the early stages of the pandemic. 4 of the 5 confidence sub-indices dropped. Current financial conditions fell 4.4%, while future financial conditions dropped 0.4%. Current economic conditions increased 1.5%, while future economic conditions decreased slightly by 0.2%. And the time to buy a major household item also fell 2.7%, dropping 14.7% over the past 3 weeks. According to ANZ Head of Australian Economics David Plank, consumer confidence dropped 1.3% last week, its third consecutive weekly loss. Last week's decline was mainly driven by drops in the sub-indices that capture the financial situation compared to a year ago, and whether it was a good time to buy a major household item. This suggests that costs of living concerns are front and centre of consumers. Among the respondents paying off their home loan, confidence dropped 0.6%, falling a cumulative 14.7% over the past 3 weeks. Confidence was 2.7% lower for people who own their own home, while it rose 0.5% for people who are renting. Household inflation expectations rose 0.2 percentage points to 5.3% amid higher petrol prices, and inflation expectations have risen slightly following the plunge after the fuel excise was halved in the federal budget. And of course, those temporary support mechanisms will unwind, putting more upward pressure on inflation. So standing back, whether you look at the employment statistics or the confidence statistics, or indeed the forward leading indicator statistics, you have to ask the question, are they really great economic managers? We seem to be facing into a gale here, and maybe it is time for a change in the political weather, because the current mob really have done us no favours at all. Now, if you're buying your home in Sydney's contentious market, you don't need to stand alone. This is the time you need to have Edwin from Ribbon Property Consultants standing alongside you. Buying a property is both challenging and adversarial. The vendor has a professional on their side. Emotions run high, price discovery and price transparency are hard to find, and then there's the wasted time and financial investments that you make. Edwin understands your needs, so why not engage a licensed professional to stand alongside you? With RPC, you know you have experience, knowledge, and master negotiators looking after your best interests. So shoot Ribbon an email at info@ribbonproperty.com.au, and if you use the promo code DFAWTW/Martin, you can get a 10% discount offer. I'm Martin North from Digital Finance Analytics. Many thanks for watching, and I'll see you again next time.